Today we're analyzing the overhyped Palantir technologies. Now, there's a lot of retail investors that are interested in this stock, and I don't want you guys to get destroyed. So that's why we're going to do a fundamental analysis of this business, and you'll see why I'm not super excited about this stock. Now, let's take a look at the 5-year chart. They did IPO in 2020, and then they had a massive run up, and then they got crushed back down to $7 a share, and now they're back up to 20 bucks a share. They are almost a $50 billion company, $45 billion company with a price to earnings ratio of 234. Very, very steep, so they better have some growth, and hopefully they can expand margins. So let's take a look at their financials. Let's look at their statements. Taking a look at their revenue growth. They do have steady revenue growth, which is always good to see. In 2019, they only grew by 24%, which is interesting to see, and then it really accelerated out of that. And then last year, they only grew by 16%. So I'd say moving forward, they're probably looking at about 15% revenue growth moving forward, and then maybe less going forward from there. In terms of their net income and how it translates, well, their margins are actually very slim. Okay, their gross margins are really high, but then you have to pay all your workers. And this is the part of Palantir that's kind of interesting. So it's a software business. So this is the software expenses, 430 million. So that's why their gross profit's so high. But they're also a consulting business, and they have a lot of consultants that they have to pay. And so that's why their margins aren't super high, is because they have to pay a lot to their consultants, and then they have R&D expenses as well to update their software and make sure that it's good. So margins are not that good. Maybe they can expand them in the future. Probably they will. So we'll have to take that into account. In terms of their net income, they were negative like pretty much every year before last year. Last year, they actually had a positive net income, which is always good to see positive net income. And their shares outstanding, they have been diluting shareholders quite substantially. Especially last year, they diluted shareholders quite a bit. Taking a look at the balance sheet, they do have a really great balance sheet, probably because they've been diluting shareholders. They have negative 3.4 billion in debt, so amazing balance sheet, nothing to worry about there. In terms of what they're doing, okay, cash flow. Okay, they had 700 million in cash flow last year, which is really high in comparison to their net income, right? They have 600 or 700 million in cash flow, but their net income is 209 million. So this $500 million difference is primarily due to stock-based compensation. Stock-based compensation shows up on the income statement, but it doesn't show up on the cash flow statement. So that's why their cash flow is so much higher. In terms of their financing, what are they doing with their cash? Well, they are actually just diluting shareholders, getting some more cash, and otherwise they're just letting the cash sit on their balance sheet for now. Let's take a look at their stats really quick, see what their margins have been looking like. Yeah, gross margin, of course, has been really high at 80%, and then last year they had a gross margin of 10%. Let's take a look at, what do we want to look at? Let's take a look at the analyst estimates here. So this is what I'd like to use for my DCF model. We can see in 2024, they're expected to do 2.7 billion, which, one sec, how much is that? 2.7 billion compared to 2.23 last year. So that is what, 2.7, that's like a 20% growth or 25% growth. That's actually pretty high. And then after that, they're expecting, oh, actually, it was right here, 22% growth. And then they're expecting to go up to 19% going into 2025. Will they be able to hit that? Maybe, maybe not. Let's take, and then stats as well. They are 4% short, which is kind of high. Usually above 5 would be a big red flag. So they're under 5, but still 4% is pretty high. Let's take a look at this. Okay, this is something I wanted to show you guys. We're on Market Beat here, and we're looking at the institutional ownership at 45%. Not a massive amount of institutional ownership in this stock. And we can see that they didn't buy at all in 2022. or the first quarter of 2023, and that is when their share price was really suppressed. So if we look back at this, institutions were not buying at all when the share price was suppressed, and then like right in here they started buying a lot, and that's when the share price jumped. So some people say that the institutions were buying when they were at a low point, but they weren't. And you can see that based on this. And you can see that the institutions are not buying at all right now, probably because the share price is too high. And I wanted to look at insider trades. And we know that Peter Thiel owns a lot of this company, and he actually sold a lot of shares in Q1. He sold $174 million worth of shares, which is a lot. He probably owns like $5 billion worth of this company, or something like that. 174 million is a pretty sizable chunk of that. I mean, it's not like a ton, but it's still quite a bit of shares. And he sold them at $25 a share. He's a pretty smart guy, so yeah, it makes sense why he would sell it when the share price is like pretty much at its peak. And now the share price has come down quite a bit, down to like 20. But let's take a look at the DCF model that I have for these guys. Here we are. I put in the EPS and revenue estimates from Yahoo Finance. Buybacks of 0 and net debt of negative 3.4 billion because their balance sheet is so good that they have negative debt. Discount rate of 10% because I want a 10% return on all of my stocks, and an exit multiple of 25. Now, this might be a little bit high, but I do think that this company probably has room to grow for a long time into the future, especially if they are getting into that AI space. This might be generous for this company, but we'll say 25 for now. In terms of their discounted earnings model, we're taking their projected EPS and we're going to grow it by 15% a year. And if we grow their earnings per share by 15% a year, they are worth $14.62 at the current time. And what I really like to use is the margins model, because it makes it easier for me to value companies that maybe have really slim margins right now that might be able to grow them in the future. Now, the thing with this is the analysts are projecting that Palantir is going to have a 27% profit margin, which is very steep. I really don't think that they're going to hit 27% profit margins. Last year, they did 10%. And they would really have to expand margins a lot to get to 27. And it's probably not going to happen because they do need to pay their consultants. So like their profit margins aren't going to expand that much with extra revenue, at least in my opinion. And then they're projecting 19% growth in their revenue. And historically, they've done 15%. So I think 15% is fair, and then leveling off at 10 because normally, if you get to higher and higher revenues, it makes it more difficult to grow exponentially from there. So that's why I usually taper off revenue growth like that. And yeah, 27% I think is really, really high. But even with this, what I think is a very optimistic scenario for Palantir, you're still overpriced on the stock, and the fair share price should be around $13 a share, assuming that this scenario plays out. And yeah, that's if you're expecting a 10% return. But if you bought them today, you'd probably be expecting like not even a 5% return, probably like a 4 or 3% return. So yeah, probably not the best time to buy, especially because the profit margin might not even be this high. They'll probably do like 12% margins next year. And then from there, maybe they'll get to 15 and maybe 18 from there. I could see them getting up to 20% margins, but I don't know if they'd go past 20 just because they've got that consulting side of their business. And if this more realistic scenario plays out, then you're looking at a fair share price of $10 a share, which is almost half of their price right now. So yeah, don't believe the hype in this stock. It's really hyped up a lot, and so that's why the price is so elevated. But institutions aren't buying, the insiders are selling, and you should probably sell too. that's my 2 cents on this stock. I hope you guys enjoyed. If you did, please hit that like button and leave any comments. Feel free to debate me in the comments as well, and I'll see you in the next video.